Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to start talking about finance. And I'm going to start from the very basics so you can learn that finance isn't as scary as it sounds. For starters, I believe that most of the financial concepts are very easy. The thing is, they have a specific terms that people are using in real life. And learning that jargon is what's going to help you know what are people talking about, and it will also help you apply all of these concepts. So, thinking about that, today I brought the top 20 financial concepts that you should learn so you can start understanding a little bit more about finance. So, for starters, I just wanted to say that there are two types of finances. There's investment finance that's trying to find what is the value of an asset, but there's also corporate finance, which studies how corporations behave, how they take decisions, and how to make those decisions the most optimal decision. And here, I'm going to start focusing more about corporate finance, but as I'm telling you, all of these concepts, you can apply them in either investment finance or corporate finance. So the first term that I want to explain is one that I've been using in other episodes, and it's inflow. Inflow or cash inflow basically means that you received money. And the opposite of that, an outflow, means that you're paying money. So this may sound very simple, but you might get confused because people are not talking about paying or receiving money, but they're talking all the time about cash inflows and outflows. So if you have inflow, you're receiving it. If it's an outflow, you're paying it. And now, I'm going to introduce two of the most important concepts in finance, but for that, I'm going to tell you a story. Let's imagine someone promises to pay $100 for the next 5 years. How can you say how much money you have today? Do you have $500? Can you just add up all the 100 for every single year? That would be incorrect, because that would be assuming that money doesn't change its value over time. Value, it's always changing, and the money in the present is worth something different than the money in the future. This is going to be one of the most important financial aspects, and this will introduce us to the terms that are called present value of money and future value of money. In my next episode, I'll show you how to do this conversion between the present and the future, but for now, you just have to be aware that you can't say that $100 in 5 years is the same as $100 today. For reasons like inflation or just other opportunity costs, this is going to be not the same. So present value of money, it's going to be different from the future value of money. And so there are two ways of knowing that this value is the same. One of them is compounding. And this is going to mean that you're moving your money from the present into the future so you can compare the future value. And the other option is called discounting. Discounting is the opposite. You're bringing money from the future into today's present value or into the past value. For doing these two formulas, you'll need a couple factors, but I'm going to explain all of them. The first one is the discount rate, and this is probably one of the most important factors and one that does not make sense to many people as soon as you hear it. Discount rate basically means the interest rate, which will act as the percentage for determining the value you're moving it into the future or into the past. What's important is that this value captures the risk. So if something is riskier, it will have a higher discount rate than something that's not risky and will hold a lower discount rate. Another important thing for transferring money in time would be the compounding frequency. So, compounding, as I told you, is moving money into the future. But this is also how you start earning interest. Compounding frequency might change because if you put your money in the bank, you might get interest at the end of the year, or you might get it monthly, or semi-annually, or weekly, or maybe even daily. This compounding frequency will have an enormous effect on the transfer of money between time. And this compounding, even though it's very small, it's huge, not only in finance but in real life, because it means your interest starts earning interest on a bit more than the original amount. It's basically interest earning interest on itself. And this, according to Einstein, is probably the eighth wonder of the world. After you do all of this discounting formulas or present value, future value formulas, what you're going to find, it's usually going to be the net present value. The net present value, also known as NPV, is all of the inflows and outflows that you have from a project or from your life, but they are all in the present tense. So you have to discount all of the payments, all of the inflows and outflows into a present tense, and when you add it up, that would be the net present value. And this value is going to be extremely important for projects and finance decision making because there's a simple rule called the NPV decision rule. And it's that when you have to choose between different alternatives, you should always choose the highest NPV. Because NPV, or net present value, it's the value that a project creates. If after doing a big investment, you find that net present value is positive, it means that after many years, you would have created all of this new value. If it's negative, it means that all the money you invested or did in the project was worthless and you're actually destroying value in the present. So that's why NPV, or net present value, is going to be so important for taking financial decisions. And it's one of the most decisive factors when taking decisions optimally in finance. There's another thing that's called internal rate of return, and this one's also used for taking decisions in finance. Internal rate of return, also known as IRR, is when you already have the cash flows, but you want to know what was the percent or like the discount rate that got that project. Basically, what was the interest rate that gave you the project? So when you take out the IRR, that is going to show if it's a positive investment or if it's a negative investment. Because a high IRR will mean that you're creating more value, but a lower IRR will mean that you're not creating value or maybe that you're destroying value. So these two things, NPV and IRR, are going to act as two fundamental measurements for knowing how good a financial decision is. Now that I've finished those 10 first financial terms, I'm going to move on to a couple others, where I'm going to start explaining specific investment types. And I'm going to talk about two of them, bonds and stocks. So first of all, what is a bond? Bonds are investments that are sold by governments or corporations to raise money in exchange for periodic payments. So let's imagine this. I want to buy a bond from the U.S. government. And so I'm going to give the U.S. government $100, and maybe they promise to pay me $5 every year for 5 years until I get my money back. So I give the U.S. $100, then I'll start receiving $5 on year 1, year 2, year 3, year 4, and on year 5, I'll receive my $5 plus the $100 I lent to the government. This is going to be an investment type that is mostly used by governments, but it's also used by corporations. And as you can see, it's pretty safe because you have your returned money promised and you'll have specific coupons that are going to be the promised interest payments of the bond, depending on the periodicity. So they might be semi-annually or annually. The important thing is that bonds have three things. They have coupons, which is the payment I was talking about, the periodic payment you'll receive. The face value, which is the amount you used to pay for the bond and the amount you'll receive at the end. This is the value usually used for computing the interest, and it might also be called the principal. And the third one is the yield. Yield is basically saying the interest rate or discount rate, but only when talking about bonds. So yield or yield to maturity would be the internal rate of return for a bond, assuming we're holding it until the maturity date. So I'll recap over here. We have a specific type of financial investment that's called a bond. And this bond will give you coupons, periodic payments, and then at the end, it would also promise a face value. The coupons are calculated through the yield, which is the interest rate. Okay? And so all of this is related to a type of financial concept that's called annuities. And so annuities are streams of periodic cash flows during a specific time. So basically what I was just saying, bonds will give you annuities. They pay a specific amount during a specific time. But what if the time is forever? Then the annuity would become a perpetuity. Because perpetuities mean that you're receiving a stream of cash flows, but this one occurs in regular intervals that will last on forever. Perpetuities might sound more ambiguous because what might give you a payment forever? And this is the second type of financial asset that I wanted to talk about, and it's stocks. Stocks are shares that are representing the ownership or equity of a corporation. So basically, when you own a stock, you have a little part of the company. You're owning that company. And stocks are going to be some sort of perpetuity because they don't promise a payment at the end. They just may promise a stream of cash flows that may last forever or at least a long amount of time because it will be the amount of time that the company is alive. Stocks don't have coupons, but they may have dividends. And dividends are payments that are made by a corporation to the owners or shareholders. And these are going to be the owners of the stocks. And so stocks are a bit similar to bond, but they are more risky. So usually their discount rate is going to be a little bit higher because they will promise more growth in exchange for more risk. These are the two types of assets that you might find in today's world, stocks and bonds. And I hope that understanding all of these concepts will help you already set the standards into calculating all of the future value, present value, interest rate, payments, and also the time that you're going to receive all of those payments. I just mentioned 5 factors, and those are the ones that we're going to use for moving money in time. But I'm going to talk about that on my next episode, so be sure to check it out.